Hi, I'm Patu from FreeFinCal. In this video, I'm going to talk about one aspect of mutual fund investing, especially equity mutual fund investing, that if you do, you will never get rich. And yet, many people sadly do it. Perhaps, in a way, it is necessary for a lot of people to do it so that we don't do that. Let me explain what I'm talking about in a series of slides. So the first is this is on the top. You see HDFC top 200. You see the AUM growth on the left axis. The turnover ratio is here on the right axis. Don't worry about that. The AUM growth is shown here, and you can see the Nifty growth here. That's just a snapshot from Money Control. So what I'm trying to show you here in this graph is that notice when the AUM grew from 2000 crores, it became 10,000, 11,000 crores or so in a very, very short span of time. That's the time when India recovered, and after the recovery, people started investing. So people always, this is a problem, they always invest in equity in general or in equity mutual funds after the recovery. When there is a crash, they don't invest. When the index is falling, they don't invest. But they invest after the recovery, and that's a very nice classic example in the case of HDFC top 200. But I'll show you much better data than this. This is some data that I had gathered 2016 or so. So this is probably a lot more telling than that. What you see on the top is a screenshot from AMFI, one of the AMFI reports. What you see here is the number of investor accounts in crores, and it's 4.76 crore investor accounts in March 2009, and it dropped mid 2014 to 3.95, and then it rose. Notice that if you look at the Nifty movement during this period, notice that roughly you notice that when the sideways market began, the investor accounts, number of investor accounts started dropping, and then it kind of fell down somewhere here. People didn't expect equity to recover, and then when it suddenly did, right here, when it started spiking up, then they started investing, and then the number of investor accounts increase. This is the problem. Many people do this. They look at an asset class perform and then invest. Oh, gold is giving so much returns in the last 1 year, I must invest. No, then after you invest, it will fall down. That, it's just stupidity. I mean, and yet there are so many people who do it. Perhaps there's one way to argue that you need stupid people around. You need people to behave badly like this for you to get rich. But this is what we should not be doing. If you want to get rich, you must stay in equity when it is not doing well. If you should invest more when it is falling, when it is sideways market, you should keep investing more. That is the only way to build wealth. You have to bear the pain and go through that. Never ever do this. There's no way you can get rich if you do this. And this is not just us. This is happening in the US as well. So what you see here, this is from knowledgeleadercapitals.com, capital.com. So what you see here is the blue is the S&P 500. It's a very nice distinctive curve. And you see the equity net inflows. So this is not the AUM, but the net inflows. I'm going to show you net inflows for our industry very shortly. But this is what what happens in the US as well. When the S&P 500 starts moving up, the net inflows spike, and then when it falls down. And then when it recovers, it starts moving up, and then when it falls down, it starts falling down again, and the net inflow becomes negative, which means people have started redeeming. So this is the problem. People are always buying high and selling low. This is just crazy. This happens everywhere. So these are snapshots from Mint. Live Mint has been regularly producing these kind of pictures about net inflows, and you can see here January 2014 to January 2017. This is the 1 year return in the BSE 100 index and the BSE mid cap index. Those are the solid lines shown here, and you can see the net inflows into equity mutual funds. You can see they were negative, and then when it starts moving up, then the net inflow starts moving up, and then it's peaks, and then when it starts falling down, it falls down again, and then it moves up again. So even though people talk about SIP book increasing and so on, SIPs account for somewhere between about 45% of the net inflows. Even though that is the case and it's growing, still people redeem when the markets are falling down, and people don't. They're scared of investing when the markets are actually down and they're falling down. They're scared of investing. They don't want to invest, and that's even though they may have their SIP going. But the problem is, for most people, the SIP is just pittance. They don't commit a lot of money into SIPs. Just pittance, few thousands here and there. So this is the big problem. It's just all the graphs I'm going to show you just show the same thing again and again. So this is up to January 2017. Look at the growth in the assets of the total mutual fund industry. This includes debt funds as well, but you can see that it will reflect, the growth will reflect the equity markets. So 30.5% growth between August 2016 and August 2017, almost linear like growth, independent of the market. That's when the markets were zooming, remember. Then 17.8% growth between August 2017 and August 2018. Remember, by the time by January 2018, markets had peaked and had started falling down. So already you see that slight dip in the growth. Then between August 2018 and August 2019, it's just 3.8% growth. So that's the problem. This is the period when the markets have been falling down. The mid cap index fell down, large cap index fell down. Only the large cap index was kind of keeping alive, but the mid cap, small cap index fell quite a bit. So many funds had negative returns, and during this time the assets did not grow at all. So which means that net inflow is very poor in this period. That is again, it's just the same thing. People are selling low and buying high. That's the problem. So one more graph, same thing from May 2018 to May 2019, and this is from July 2018 to July 2019. You can see that there's a big drop in the net inflows, and the net inflow started picking up in the last couple of months, but it's still quite low from what it was even a year back in July 2018 or so. You can see the redemptions have moved up. So that's again the same problem again and again and again. And again the same graph, but this is from December 2014 to February 2019. You can see February 2019 has gone below 2014 in terms of the net inflows, and during this period you can see that when the equity market moved up, the net inflows moved up, and when it fell down and was sideways or so on, there was fear, then it fell down. Then when it started moving up, after that people start investing, and then when it starts fluctuating, people stop investing and so on. So please don't do this. You can never get rich. You have to bear the pain. I have a video on this. You have to bear the pain and invest in equity. You have to invest when the market is falling. You have to invest a lot of money during that time when the market is sideways. That is when the wealth will explode, when the market zooms up. Otherwise, there's no chance. If you're seeing, last 1 year return is 40%, I'm going to invest, then the next 1 year is very likely to be very low. That's just, you can call it mean reversion if you want, very crudely, but that's just a case of what goes up must come down. So please don't invest after the thing has gone up. Then you're likely to see the fall, and then you'll get scared, and most people will never come back to equity again. So don't do this. You can never get rich. Of course, you can argue that we need people to do this for other people to survive, but let's just try and be the few people who survive and keep our necks up, first survive and then thrive. Maybe that's selfish. I don't know. If everybody becomes financially illiterate, then everybody will become poor, or at least nobody can become richer. That's one way to look at it. I'll catch you again later. Bye.